afternoon, everybody. Welcome to our webinar. This is a recording as I will be away in the bush next week or this week, and I do not know how good the internet will be there. So my name is Sean van den Berg. I am an investment specialist here at PSG Wealth, if you don't know me. Last week, Thursday, that's the 16th of June, obviously we celebrated a public holiday, and the public holiday is called Youth Day. And you can see by our title of this presentation that start investing young and retire early. So the whole focus is obviously on our young investors. So when you're a young adult in your 20s, retirement seems far away, very far away in fact. But the earlier you begin planning for retirement, the greater your potential return for investment on your investment. So many you might be thinking, oh, geez, why retirement now? Why is retirement planning important? Bottom line is because it will help you avoid running out of money in retirement. You just realize that sooner or later there will be a time when where retirement is a time where your active income will stop. So hence this presentation today. So many young adults do not take the time to understand how to invest wisely. Often this is because they're concerned about the here and now, not the future. But also by taking a longer term view and investing consistently over time, young investors will be able to ensure that their savings and net worth are there when they need them. So please join me in this webinar as we discuss why it's never too early to start investing for your future. It might seem complex or even unimportant, but investing is easier and more accessible than ever. So here's the agenda, what we're going to be covering in this short presentation. And I say short presentation, it should be about half an hour. Why save for retirement in your 20s? Obviously, I touched on that already. 5 reasons to start investing early and in the best types of investments as for young adults. Okay, so let's get started. The first thing I want to say is never think that a young age is a barrier to making an investment, as you're never too young to invest. So I'm talking to two age groups specifically today, young people as such. Number one is the millennials, and number two is what we call Generation Z. Now that's younger or older people might think, what's the difference, or how do you describe them? What is a millennial? A millennial refers to those people born between 1981 and 1996. So it all goes on what it's defined by obviously the name millennial, and that's the whole thing is that they were born near the end of the millennium. So that's number one, is the name, obviously the birth year, and the ages in 2022. So for example, the millennials would be anybody now aged between 26 and 41, whereas Generation Z, these are the people that are born between 1997 and 2012. Their ages are from 10 to 25. So those are the groups I'm talking about today. So what's so special about the millennials? So first of all, must understand that the millennials is the most populated age group in modern history. That was quite interesting to read that. Number two, they're the most educated generation on record. Okay, so a university degree is a prerequisite for an increasing share of jobs, a possible side effect of the split of the economy into obviously the higher skill and lower skill workers. It's also interesting to note that, do you know that student loan debt is one of the biggest problems for the millennial generations today. Okay, so just to get going to it, today's millennials and Generation Z are a growing force in investing, as they have more economic power than any generation that preceded them. This new generation are driving the capital to new frontiers, new platforms, obviously with new priorities. They're earning more, saving more, and investing earlier and at a higher rate than previous generations. Okay, so for millennials, 31% of them started investing before age 21. compared to only 9% for the baby boomers and 14% for the Generation X. So what's interesting to note also is that they have a passion for the environmental, social, and governance, what we call ESG investing. And they have helped drive the 10x growth in ESG inflows in the last 2 years. So just some background information there. So why save for in your 20s? Three main reasons, but obviously I'll go into more detail just now. You may not be earning a lot right now as you begin your working career, but you have one major advantage over the richer, older folks, and that is time. Okay, time is on your side, as they would say. With time on your side, saving for retirement becomes a much more pleasant and exciting prospect. You're probably still paying off your student loan debt, but even if a small amount saved towards retirement can make a big difference in your future. Okay, so that's number one. Obviously, one major advantage over the richer older person is time. Number two is going hand in hand with that is compound interest is your friend. You know, and I think this is the best reason it pays to start early with retirement planning. Yeah, if you're unfamiliar with the term, compound interest is the process by which a sum of money grows exponentially due to interest building upon interest. So it's your money growing upon its previous growth. But we're touching on it, an example just now in the presentation. So saving early versus saving a lot later. So you can start as little as 500 Rand now a month, okay? And then, as I say, you'll see a slide just now where as you get older, you have to start investing a bigger contribution just to try and get to the same ballpark, okay? So that's a major advantage. You can start small now, okay? So 5 reasons for starting investing early. In our or in the early or mid 20s, when we start our first jobs, the salary amount that we get obviously not very high. Now from that, we must also obviously manage our monthly expenses like rent and food and our commute or travel costs and things like that. And especially now with cost of living going up, petrol price going up, it's even getting harder. But now with the newfound freedom of having money in hand, the urge to spend is more. And at this life stage, saving and investing are the last things on our mind as a 20-year-old. Okay, but investing, as with anything in life, benefits from an early start. The earlier you begin planning for retirement, the greater your potential return on investment. I know I'm repeating this stuff, but I'm harping on the idea of time. Okay, so by taking advantage of your youth, you can get a head start on saving for your future. Okay, so as I mentioned just now, the main reason is obviously taking advantage of time and that magic of compounding growth. So as I said, I'm repeating myself here, time allows you to take on risks. So the earlier you start, obviously you're giving yourself more recovery time. Typically when it comes to investing, ventures that are most volatile yield the highest return on investment. So having exposure to the share market and the share market historically has given you the higher growth compared to putting your money in the banks, for example. Okay, that's number one. And number two was also important here with point number one is if you invest early and incur loss, you have more time to make up for those losses on the investors or on the investment. Investors who have time to recover if something were to go wrong can make riskier moves. In other words, with early investments, your investments get more time to grow in value. So those who begin to invest late in life are inherently obviously more cautious with how they invest their money. So the bottom line here is that apart from earning handsome returns at a young age, it also helps you to you have this we call a higher risk-taking ability. So that's number one, allows you to take more risks. Number two, as I touched on just now, compound interest makes a real difference, and I believe that's one of the best reasons for getting involved, as I mentioned earlier. So it's just money making money. Okay, money growing on top of money. Your spending habits will improve also. You know, as you start investing early, you develop a disciplined spending habit. Okay, by focusing on your budget, but also obviously cutting expenses when needed. It's impossible to with poor spending habits and a life full of impulse buying, to be disciplined like that. Okay, so that's one of the major advantages I say, is to learn the pattern where you start seeing it's easy, or at least possible, to achieve financial independence, and that comes through, as I say, with discipline. If you do have a problem with discipline, I suggest that you ask your employer to deduct from your salary before they obviously get paid out, what we call pre-tax. Have a deduction for a retirement annuity. Number one. Number two, if it's put it on a debit order if it's after tax. Put it on a debit order, make it automatic. That's a nice thing about it. You can use technology to your favor. Be a step ahead of everyone else, and I believe this is also, there's an old saying, the early bird gets a worm. It's an old idiom, which is a worthwhile adhering to. The earlier you begin investing, the better your personal financial situation will be down the road. That's number one. Number two, compared to your counterparts, your friends, who may have chosen to invest late in life, over time, you'll be able to afford things that others can't. Okay. Additionally, at some point, your finances may become unstable. But if you, and we'll discuss it a bit later, if you looked at creating an emergency fund, you'll be able to handle that. You'll be able to be better prepared to face those hardships. Okay. But as I say, with emergency fund, obviously you can meet those unavoidable expenses, but it's been budgeted for. That's the point I'm trying to make. And also, you won't have that need to go borrow, going to credit and things like that, and have the champagne lifestyle on the beer income, as I would say. And then lastly, your quality of life will improve. If you have a retirement annuity in place, it just also gives you that peace of mind that I'm looking after my future. And you don't have to worry about being forced to make some reckless decisions or choices to secure a more secure retirement down the line. Okay, so I hope that gives you some motivation. What are the best investment vehicles for a young adult? So first of all, I want to highlight, if you do not have, if you do have a job that or a company that offers a pension or provident fund, take advantage of it. But if you don't, I sincerely recommend that you take advantage of a retirement annuity. We'll touch on it just now, but as I mentioned just now, remember, it's all about pre-tax money. You can go one step further, also look at a thing what we call a tax-free investment account. This is ideal for the 20-year-old somethings, because most of people in this age group are in a lower tax bracket than they will be when they retire. And the main thing about this here is that you're contributing after tax money and you can withdraw tax-free. Okay, so we'll touch on it again just now, but the main thing I'm looking at here is that, yes, you've got flexibility, you've got access to funds when you want to. You're not locked in like a retirement annuity. With tax-free, it gives you that bit more flexibility, so you have access to your funds. But the main thing is it's using a tax-efficient vehicle for yourself. So before getting into the whole nitty-gritties or the investment vehicles, I just want to touch on something that I found also quite interesting, some questions you can ask yourself. So irrespective of if it's big or small money, the investment principles are the same. So, if you have money to invest, whether it's 1,000 or 100,000 Rand, I want you to think about it carefully. You need to make, or the way I mentioned just now, and I touched on it, is make the most of tax breaks. Any opportunity where you can take advantage of tax efficient vehicles, use it to your advantage. That's number one. Number two, obviously you want to make sure that your funds or your savings are in an investment or a fund where you can get the lion's share of growth, and I'll be touching on that just now. Okay, so there's some questions you need to ask yourself. What is your investment goal? When you're first starting out, you might say, gee, I'm saving for a rainy day. That could be that emergency fund. And I sincerely believe that should be your first goal, is to create that emergency fund. We have touched on this before in previous webinars. Rainy day fund or your emergency fund is at least 6 months salary or 6 months expenses. saved up into a money market fund, we can have easy access to it. That's number one, what's important here. But you might have a goal that you want to save up for a holiday or a car or a deposit on a house. So a unit trust account, or what we call a voluntary investment plan, will be best for that. But you can also have all these different accounts for different investment goals. That's the point I'm trying to make here. Okay, but please take in consideration, take advantage of the tax benefits you come through a retirement annuity. Your contributions are tax deductible, but also take advantage of the tax-free. Okay, so those are the three main products I'll be talking about today. Okay, so when do you need the money? So obviously, if you're planning for retirement, we're talking about the earliest you can access your funds is the age of 55. So that's very important to look at. I believe one of the big advantages of a retirement annuity, that your investment is, call it, locked up, so you don't have easy access to it. So it's great for disciplined investing. You do have the flexibility. You can stop and start your monthly contributions as and when you want to. Obviously depending on your circumstances, but the main thing there is you won't be able to access the funds until the age of 55. Okay, but that's why I'm suggesting that you also look at a tax-free, so you can have a tax-free. Remember, your contributions are not tax deductible, but when you take your investment out one day, all that capital growth, dividends, income, all that kind of stuff, interest income, is all tax-free. Okay, so there's different investment vehicles for different time periods in your life. Okay, and also very important is what your appetite for risk. And we touched on just now when I said that the younger you are, the more risk you can take on. So you can say yourself, you can either be a very conservative investor. You know, you want to preserve your capital. And that's for mainly for someone who's about to retire or close to retirement. You want to be more conservative. But as you're younger, you can be more aggressive and have more exposure to the equity market. As I said, over the long term, historically, the share market is giving the best returns, and that's saying the higher the returns, the higher the risk. They work hand in hand. But also you might say to yourself, gee, I'm a bit more of a moderate investor. I'd rather go for some more balanced funds or asset allocation funds, whatever the case might be. You need to determine for yourself. And then how much will the investment cost you? So fees are very important. You know, on our platform, the PSG Wealth platform, we've got over 450 funds you can choose from. That's for the voluntary investment plan account, the unit trust account. RA's retirement annuity, obviously the funds are a bit more limited in the sense that they have to meet regulation 28 requirements, but there's still a long list you can choose from. But when it comes to costs, if you want to invest into a PSG fund, the monthly admin fee or the annual admin fee is 0.3% if you're using a PSG fund. If you're using any other funds, the admin fee is 0.5. Doesn't sound a lot. That 20 basis points over long term does add up. That's what's so important. So you need also ascertain it. What will it cost you? So now the average paid by South African investors is around 3% per annum. That's on all those different funds. We talk about the broker cost, the admin, the platform fees, the investment management or the fund management cost, all that kind of stuff. So you need to look at those kind of things. What will the investment cost you? And also what's important, what is the fund performance? And this is where you're going to look at the asset manager's track record, ideally 10 years plus. So, you know, what's also important is where do I find this information? So we have a tool called Funds A to Z, and it helps you compare different funds, but also from that, you'll be able to find the funds fact sheet. Okay, and that's also a very useful tool to help you look at the fund performance and the benchmarks, etc. And then also, lastly, to understand what I'm in for. You know, remember, it's long term. Number one, so that long-term commitment. Number two is, you know, your investment strategy obviously will evolve as you get to different stages of your life and things like that. But what's important is, will you be able to see how your savings are performing? And on the PSG platform, you have online access. You can log in anytime and look at your portfolio. You have the flexibility of switching funds and things like that. Okay, but the more information you have, And the more you weigh up the pros and cons about your investments before getting involved, the better you're going to be. And obviously, down the line, your future self will thank you for taking the time to ask yourself these kind of questions. Okay, so let's get into the nitty-gritties. As I mentioned just now, the very first investment, I would call it unit trusts with a voluntary investment plan. Main thing here, big advantage, you got access to your funds, you got flexibility, all that kind of things. You can set up a monthly debit order, but obviously the temptation is always there to liquidate your funds. But this is where you're going to use for an emergency fund or more of a short to medium term goal, like a deposit for your house. This is the ideal vehicle for that. Okay, you can either go with a lump sum, and the challenge there is getting you might be buying at the top of the market, we might be buying at the bottom of the market. So just be aware of that. You have the option also to phase it in if you want to do a lump sum. I personally prefer a monthly debit order. You're also taking advantage of rank cost averaging. Okay, so just be aware of those kind of options also for yourself. Then we talk about a tax-free. I touched on it just now. This is where you can complement or supplement your retirement annuity. So there are limitations. You're limited to investing 36,000 Rand a year or 3,000 Rand a month. Just be aware of that. That's number one. And number two, you can't put in, you can't put in more than that, because if you put in more than that, you're going to be penalized. If I put in, for example, 40,000, that extra 4,000, I'm going to be taxed at 40%. So, that 4,000 at 40%, that's an extra 1,600 Rand in tax we're going to be penalized for. Okay. Another thing is, if I'm putting in 36,000 a year, you have flexibility. You can take it out, but you can't put it back. That makes sense. Okay. So the tax benefits over the long run are great. You're taking advantage of compound growth. And also, if you're investing in high growth assets, you're going to even have better growth, better returns. Okay. And then the third investment vehicle I want to talk about is retirement annuity. I've been mentioning this whole time. Your contributions are tax deductible. That's number one. Number two, that's disciplined savings. You can only have access to your funds at the age of 55. There are limitations in the sense that Regulation 28 limits, obviously, your equity and offshore exposure. I know they have recently amended it now. You can go invest up to 45% offshore, but you still have a broad range of funds to choose from. But this is your first port of call. Start off with a retirement annuity. As I say, it's tax deductible, your monthly contributions, then look at a tax-free, and then look at a voluntary investment plan. Those are the priorities, but I suggest also maybe looking at creating an emergency fund first. I mentioned just now about the magic of compounding. I just want to show you the two examples here. We've got two investors. Investor A that starts investing at the age of 20. The age group we're talking about now. We're talking about investing with only a little 500 Rand a month. And you can see these contributions over the long term, at the age of 65, his contributions would have been 1.2 million, that's his own contributions, and his funds would have grown to nearly 8 million Rand. Okay, so that's number one, that investor. Number two, you can see someone starts investing 15 years later. Yes, putting nearly 5 times as much as from a monthly contribution point of view, 2,525 Rand per month to get close to the investor A. Okay, so it just shows you just that difference of starting a bit earlier, and also as I mentioned, you can start off a little 500 Rand a month. You see the big difference there. So the thing is, despite investor one ending up with the same investor, same value at retirement, compound interest takes care of the rest. Okay, so that's a big difference. I want to show you also the difference is that if you need 10 million by the age of 65, the earlier you start, as I mentioned again, you can start a little 500 Rand a month. Okay, but you start later in life, let's say age of 40, yeah, you have to put nearly 5,000 Rand a month away to get to that same target. Okay, so again, the magic of compounding takes advantage. Okay, so to quickly highlight the differences between the three different products. The main thing is, yeah, there's no age, there's no age restriction with the VIP and the tax-free. You can start at any age. You can start for your children, for example, and then get them started. with contributions being tax deductible, only the retirement annuity has that facility. Okay, you're up to 27.5% of your salary or your income, but it is capped at 350. Are there limits? Or limits obviously with your tax-free 36,000 a year or 500,000 lifetime. And then also what's important, I want to highlight for you, access to your funds. You can have access to your funds whenever you want to with a voluntary investment plan. Just obviously understand that, yes, they're always taxable, taxes paid on it, be it on the income or dividends, and also obviously tax on capital gains payable if you do switch, at least possible. Okay. You have access to your funds with your tax-free, but remember, you just can't put it back again. Retirement annuity, you have restrictions. Only at the age of 55 can you access that money. Unless you're immigrating or you're ill or the funds are 7,000, those are the only exceptions you'll be able to have. Okay. But as I suggest, when you get this presentation with the PDF, go through this again and you can compare all the pros and cons. Okay. Only the retirement annuity, the regulation 28 rule in place. And the main thing there is just to protect you as an investor. You want to put all your eggs in one basket and have exposure to high risk equities only. So that's there just to help you with prudent investing. Okay, so quick summary. I've gone through this very, very quickly, but in summary, I'd suggest is that it's important that you obviously start early. And I've been harping on it the whole time. The earlier you start, the easier it is to build wealth. Okay. Yes, you'll be facing some difficulties when you're starting out in life. Obviously, you don't have enough money, but you can't wait for the time when things are convenient for you. Start investing in small amounts, and I've showed you that for 500 Rand a month, you can start. You're giving yourself time for your money to grow and mature. That's the main thing here. Okay, so investing investing at a young age is the best decision you can make as an individual at this age. Okay, so tax efficient vehicles, I want to take it in consideration. Take advantage of that. It must be part of your plan. Financial discipline, I've touched on already. And that's, again, make it automatic, the debit orders and things like that. Okay. In conclusion, compound interest, they call it the eighth wonder of the world, but also compounding with a tax-efficient vehicle and funds or investments are giving a high growth. That's the best place to be. Okay, so start early, use rand cost averaging. Those are all the benefits, all in a big nutshell. So if you want more information on these different investments, by the way, you can just click on this link here to take you through to the PDF of these different ones, of these different investments, what we call the key information document. Okay, so guys, any questions you have, you're welcome to drop us an email at wealth@PSG, or you can also call us at 0868 000 368. From my side, thanks for being on this webinar. Obviously, here's our disclaimer. I might have given you some advice, but please construe it as education purposes only, as for you to have a greater understanding. So I hope you've enjoyed this, and we'll talk again. Bye for now.